Are new tariffs on the horizon? It sure seems like they could be. And if you're anywhere near retirement or already there, it's probably making you a little nervous. What could this mean for your cost of living, especially with the inflation that we're already feeling? And what about the economy and your retirement portfolio? These are totally valid concerns, and today we're going to talk about the very real way tariffs impact you. More importantly, we'll get into specific strategies you need to consider for your own retirement savings. So we'll start with the domino effect, how tariffs can indirectly hit your 401k. New government tariffs could be taking a serious bite out of your retirement savings, and in a way you might not even see it coming. They can act like an indirect tax on your 401k. And in the next few minutes, I'm going to show you exactly how this could shrink your nest egg, and most importantly, what you can do about it. This isn't some abstract economic theory. It's a real issue with real consequences, and the financial security of your retirement could depend on you understanding what's really at stake. So, what exactly is a tariff? In the most simplest forms, it's a tax slapped on the goods imported from another country. Think of it as a fee that the government adds to products before they even get to you. The official goal is usually to protect American jobs and to nudge you to buy American made products. But the reality is a lot more complicated, and it kicks off a chain reaction that can land right in the middle of your retirement accounts. Here is how these dominoes fall. When the government puts a 25% tariff on, say, car parts from overseas, a company building cars in the US now has to pay more for those parts. Their costs for doing business just increase significantly. To protect their bottom line, they basically have one of two choices. You either eat the cost, which shrinks your profits, but the idea is I maintain my revenue. So while my profits have shrunk, my revenue stayed the same, or they possibly might increase because those costs are lower than other companies that have to increase their price with the tariffs. Or the company will pass it on to you by increasing the price of the car, and it's usually a little bit of both. Normally, what a business will do is they will try to increase the price a little bit over time, hoping that you don't really notice the difference. That way, they're not solely taking the hit from the tariff. I remember an example when I used to live in St. John's, that's just south of where I'm currently living at now. And there was this thing called a CDD fee, a community district development fee, something like that. And there was this tax that was added on the business there. And the Walmart that was being built there, they decided they were going to pass that cost on to the consumer. But they didn't want to increase it inside their cost, so they didn't want you to think that your costs were higher at Walmart and not want to go to Walmart. They added it onto the bottom of the receipt where it said $100 was your bill. And then right underneath that, it said, hey, there's a CDD fee and it's a 1% CDD fee. So we added $1 onto your bill. You'll pay $101 today. Or it will say there's a 10% CDD fee. And so it's $110. We added $10 onto your bill today. But they had separated it out so that you knew that that was the cost. And Amazon was trying to do something very similar where they were like, hey, this was the cost and this was the cost with the tariff added onto it. But the president had called Amazon and said, this is not going to be looked at very nicely. So you need to not count that. So Amazon removed that. And you do see that there is a cost increase in the goods. It's just not being stated like this is because of the tariff. Now let's connect this to your retirement savings. Your 401k or your IRA isn't just a pile of cash. It's invested in the stock market in companies just like the car manufacturer, just like Walmart, just like Amazon. And when a company's profits get squeezed because of tariffs, its stock price tends to take a hit. And so Wall Street investors see higher costs and lower profits, and they start selling the shares, which pushes the company's value down. Multiply that effect across hundreds of companies in your portfolio. Many of the biggest players in the S&P 500 depend on global supply chains. They get materials, parts, and products from all over the world. A huge chunk of the products at the major retailers like Target, for example, comes from global supply chains. When broad tariffs are applied, it's not just one or two companies that get hit. We're talking about tech, manufacturing, retail, and consumer goods. These are the very sectors that form the backbone of most mutual funds and ETFs sitting in your retirement account. The result is a surge in market volatility. One day, tensions are flaring and the market dives. The next day, rumors of a deal sends it back up. But this kind of uncertainty is poison for stable long-term investors. We saw this play out during the first quarter, where we had, I think it was in April, it was called Liberation Day. And the stock market lost about $6 trillion worth of value because we're trying to recalculate what these companies are worth based on the tariffs that were presented. I think it was April 1st earlier this year. Well, then we get into quarter two, and there's extensions, there are carve outs, there's all of this that's going on. And then what did we see? We saw the stock market grow exponentially. And they said, guess what? That deal is actually very favorable for my company. So we're okay again. And then everybody goes back and buys the stocks again. And then you see that roller coaster, that volatility as the stocks are going up and down as the news of the day is being presented. It is important to remember that those just aren't numbers on the screen. It is a value of that company, and that value is directly tied to the value inside of our retirement savings. This creates a perfect storm for one specific group, people near or in retirement. If you're in your late 50s and 60s, you just don't have the time to wait for the market to bounce back from a major drop. A 20% hit to your retirement portfolio a year before you plan to retire, it can be devastating to say the least, forcing you to delay retirement or drastically rethink your overall retirement lifestyle. And this group has the most skin in the game. According to the data from the Federal Reserve, older Americans, those 55 and up, hold the vast majority of corporate stocks and mutual funds. This means that older Americans are disproportionately exposed to this terror-fueled market volatility. So while a 25-year-old can probably ride out the storm, someone on the cusp of retirement faces a much more immediate and serious risk. And then that moves us into how tariffs eat away at your purchasing power. If the direct hit to your 401k is the first punch, the second one comes from a different angle, but can be just as painful, especially if you're already on a fixed income. The second punch is inflation. By design, tariffs makes imported goods more expensive. And we're not just talking about fancy gadgets, we're talking about everyday stuff, food, clothes, electronics, and household goods. It's no wonder why so many retirees get nervous about the impact of tariffs on their savings and their income. A survey from the National Retirement Institute, it revealed that 63% of retirees believe that rising tariffs will drive inflation higher than what their Social Security COLAs will cover. COLA, again, is just your cost of living adjustment. Let's break down why this is such a huge deal for retirees. Most live on a fixed income from Social Security or pensions, the withdrawals from your retirement accounts. While Social Security does get adjusted for inflation, those adjustments often lag behind the real price hikes people see at the grocery store, which is a very fancy way of saying that, will my Social Security go up? Yes, it will. But it goes up months after the fact. And we have to pay for bills during the time we're waiting for our Social Security to go up. We still got to buy groceries, still got to put gas in the tank. That our expenses aren't going to wait for Social Security to increase how much we're going to make. Plus, depending on how your investments are, or if your income is tied to a annuity or a pension, depending on how your annuity and pension is structured, they might not even have a cause to go up with inflation. This means that while the price of everything goes up, that the amount of items you can buy, that goes down. The way the numbers are, if inflation is just the normal 3%, right? And we're just saying just the normal 3%, that means somewhere around every 20 years, your purchasing power cuts in half. It means that what you could buy with $10 today, you would need $20 in 20 years to purchase that exact same item. If you have a retirement lifestyle that is $100,000 a year, well, you would need $200,000 a year in 20 years to afford that exact same lifestyle. And as you can imagine, the idea that my retirement lifestyle now costs twice as much to do the same exact things that I used to do is pretty devastating when you're really thinking about it from a retirement perspective. It is not unreasonable for someone to be retired for 20 years, but now their retirement lifestyle is significantly declined if they aren't able to, at a minimum, keep up with these higher costs and this higher inflation. And the impact is already being felt in many ways. Past surveys have shown that when the costs rise, a significant number of retirees are forced to make really tough choices. For instance, the National Retirement Institute found that 52% had to cut back on their discretionary spending like hobbies and travel. A more concerning number is that 31% said that they had to reduce their spending on essentials. And then another 31% started leaning more heavily on their savings just to break even. So think about that for a second. People are being forced to pull more money from their retirement portfolio. That is at the exact same time losing value from market volatility. It's a vicious cycle that can exponentially decrease the likelihood that we'll be able to have this money by the end of our retirement. And so the problem gets even more serious when you look at healthcare and healthcare costs. Many essential medical devices, from walkers, pacemakers, all this stuff, they rely on parts from all over the world. And tariffs can dramatically drive up the cost of these life sustaining products, creating a massive financial burden for the retirees who depend on them. And so, this 1 2 punch of falling portfolio in value and the rising cost of living, from food and groceries to my healthcare expenses, that really is the core threat tariffs pose to your retirement. It squeezes you from both sides, shrinking your nest egg while forcing you to spend more of the money that you worked so hard to build over the years. This is why you can't just watch the stock market. You have to see this bigger economic picture to truly protect yourself. And of course, we don't want to just be all doom and gloom. We want to be able to give some strategies that make sense to help you. And I'll share a 5 step action plan that you can use. It's easy to feel helpless when you hear about the government policy and the global economics, but you are not powerless. Based on tons of research into how smart investors navigate these exact situations, there are concrete steps that we can take. And the goal isn't to panic, it's to have a plan. The goal isn't to try to piecemeal our way through this, is to recognize that there is wisdom, that there is experience, that these events have happened to people. So, step number one, of course, is to take a deep breath, relax. We're not going to panic. We're going to stay the course and simply reevaluate. The absolute first rule of all time markets is simple, but it's the hardest one to follow. Don't panic. When the market tanks, our guts tell us to sell everything to stop the bleeding. But the numbers show that panic selling, or allowing fear to determine how our actions are going to be, is easily the worst mistake that we can make. When you sell into downturn, that is actually the moment that we lock in our losses, turning a temporary paper loss or in the digital world type of a loss into an actual permanent loss. And remember, your retirement account is a long-term investment, right? We're in this for the long term. We know, and the numbers show that over 20 years, if you just miss the best 30 days of the stock market, which by the way, have a strong correlation to the worst 30 days of the stock market, that you will be losing money over 20 years now. That if you allow your money to stay invested over a longer period of time, then you will have the best days with the worst days. But the best days are almost always with the worst days. And sometimes it's because there's this overreaction. And then sometimes it's because the government will do something when everything is crashing. And so if you're leaving when everything is going down, and then the next day the government's like, we're going to do a TARP bailout. Well, that caused the market to go up. Or if you left when COVID first started and everything was crashing, and then the next day they said, we're going to start a stimulus program, and then the market goes back up. And that's why it makes more sense from a long-term perspective to just take a deep breath, don't panic, and simply reevaluate. Why did I choose these investments? Am I comfortable and confident in that strategy going forward? In fact, for many people, especially those who are still working and saving, a market dip can actually be an opportunity. Continuing to contribute to your 401k IRA means that you're buying shares at a discount. Obviously, it's assuming that you're buying a good company, but a good company at a discount is a great value investment. And so a strategy called dollar cost averaging, it's a very fancy way of saying that I have a certain amount of money that every single month I'm going to place in my retirement accounts, and I'm going to keep placing that exact same amount. And however I've allocated my investments, where if it's going to be, let's say it was like 10 industries and you have 10% of each industry, if one industry is doing very poorly, then when you buy that 10%, you spend that, I don't know, let's say you spend like $1,000 a month, you put $100 in that industry. If it normally bought you 2 shares, maybe it buys you 4 shares now. And then when that market recovers, you now have twice as many shares as you would have had because you bought them on the discount. Now, for those closer to retirement, the stay the course principle, it still holds true, but it's also a wake-up call to make sure our portfolio is truly ready for prime time. That brings us to our second step, which is diversify beyond the obvious. You've probably heard the word diversification 1,000 times, but in a terror-driven market, it takes on a whole new meaning. And it's not just about owning different stock, it's about owning different types of assets that react differently to economic stress. Traditionally, diversification might mean spreading money across tech, healthcare, and finance. But also, we've seen broad tariffs can hit all those sectors at once. To build a truly resilient portfolio, you have to look beyond just stocks. Think about defensive assets like high quality bonds, especially US Treasury bonds. When investors get scared and flee the market, they often go into the hands that created the issue, which is the conversation for a different day. And that is the perceived safety of government bonds, the good old United States of America, which can act as a stabilizer for your portfolio. For anyone approaching retirement, a common strategy is having a solid chunk of our portfolios, maybe 25 to 30% in short and immediate term bonds to provide more of a cushion. You all know that I'm a big fan of the three bucket strategy. The idea of the three bucket strategy is I have a percentage of my portfolio in cash, normally 1 to 3 years of living expenses, and that gives me the safety that I need to allow the market to recover whenever there's a market downturn and volatility. You then have your moderate bucket, which is only going to be like 3 to 8 years is the time frame. And the idea of these modern investments, which is like our bonds, and it could be like your annuity and different balance funds where there's not as much risk. But the idea is if there's something going on in the market, these will have some of the hit, but not much of the hit. And the idea is in that middle bucket is I'm at least keeping up with inflation, that they're probably going to get me 2 to 4% return. And as long as I have that, then I'm going to be okay for an even longer amount of time. And the idea is if I'm living on my cash bucket, my 3 years, I then sell my moderate bucket to replenish the cash bucket. So I'll sell the bonds and then I'll buy a money market account to replenish my cash bucket. I'll sell the bonds and I'll just leave it in cash in my savings account or like a CD or something like that. And then I allow that to just kind of sit there to protect me from those market volatility. And then when we need to replenish our moderate bucket, that's why we have the aggressive bucket. And that could be a variety of stocks. That could be a business. It could be the real estate market. It really could be any of these things. But the idea of my aggressive bucket is I am crushing inflation. I'm having a much higher return, but the volatility is a little bit harder to stomach. But at least if I give myself 8+ years in this bucket, then I know that they should always have the recovery. It's the idea that during COVID, the stock market had tanked, but if I was able to wait 3 years, it would have been fine. If I was able to wait 8 years, then I'm really fine. Obviously, we haven't been 8 years yet, but you get the idea. The same way you're talking about 9/11 and the stock market tanked in 2001, when you're looking into the future 3, 4 years from then, the market had already recovered. But I have to have something that I can live off of while I'm allowing the market to recover during early years. The whole point is to own a mix of things so that if there's a fire in one corner of your portfolio, it doesn't burn the whole house down. Step number 3 is to give your portfolio a tariff stress test. This is your homework. Sit down by yourself with your loved one, all that's fine, or with a certified financial planner such as myself, and take a hard look at what you actually own. The goal is to figure out which parts of your portfolio are most vulnerable to tariffs and which are most protected. And you start by looking at the top holdings in your mutual funds. Are they loaded with multinational giants that have complex global supply chains? Because that means they'll probably be hit with multiple tariffs. Companies in manufacturing, tech, and retail are often the most exposed because, again, they have multiple parts that come from multiple countries. A company that designs in the US, sources parts from China, assembles them in Mexico, and sells worldwide is going to feel pain from multiple angles. On the flip side, look for companies that might be more protected or could even benefit. These are often domestic focused. Domestic means like made within your own borders, and they get their materials and sell their products mainly within the United States. For example, some analysts, they point out sectors like utilities and certain domestic companies as being less affected by tariffs. During the past trade fights, defensive stocks, think of companies that sell necessities like food and consumer staples, have tended to hold up better than the overall market, right? And so we could look at Walmart as an example of that. Half of Walmart's profits is from selling groceries, and they have a way to source them from United States farmers more than some of the other companies like Target, who has half of their revenue generated from consumer goods, but consumer goods sales are down. And for Target, I believe it was like 60% of those products was actually being brought in from other companies. This stress test isn't about trying to time the market, it's about understanding your exposure. If you find out you're heavily tilted towards vulnerable sectors, it might be a good time to rebalance towards a more defensive and diversified position. just like we had talked about in step 2. Step 4 is to make a real plan for inflation. That second punch, the rising cost of living, needs its own defensive strategy. You have to make sure your retirement income can keep up. One powerful option for many is Treasury inflation protected securities, or TIPS. So if you're trying to limit your exposure to these multinational organizations, but then you also recognize that if I'm solely in bonds, and the bonds generally speaking aren't always going to keep up with inflation, then at least if I have Treasury inflation protected securities that are going to increase with inflation, I can have that protection. That if tariffs cause inflation to jump to 5 or 6%, but my normal bonds are still generating that 2 or 3%, well, now I can say, all right, well, I'm okay. And the reason that's kind of important, you've sort of already seen it starting to happen, where as the economy gets worse and we tilt closer and closer to a recession, what happens to interest rates? They go down. And so if interest rates go down and then you're invested heavily in bonds, you recognize that means that less of your bonds are actually keeping up with inflation. And so you have to have something that is not only safe and helping with a volatile market, but is also keeping up with inflation. And that's why I really like the 3-bucket strategy, because you're going to have a portion of your portfolio that is going to beat inflation, a portion that you hope keeps up with inflation, and then a portion that's liquid that we recognize doesn't keep up with inflation, but that's okay, because the idea of that is more volatility protection from market swings. So beyond just investments, this is also about your budget. If you haven't reviewed your retirement plan in a few years, now would be a great time to do that. Factor in the higher than average inflation rate into your expectations and projections. It might mean that you need to tweak your withdrawal strategy or your spending plan, or maybe the date that you retire. There's normally always 3 choices that we have when it comes to putting a retirement plan together. Either invest more money to cover that gap, either spend less money to cover that gap, or I wait another year or 2 to retire so that my money grows longer and I have less years of retirement to cover with that money. So that's kind of like the double punch where it helps me to make sure that I don't run out of money in retirement. It's way better to make these adjustments now than to be forced into them when you realize that your money is running out faster than you thought in retirement. Remember that studies show that 31% of retirees were already dipping into their savings more than they had planned because of those higher costs. Planning for inflation is the best defense against becoming part of that statistic. And then our 5th and final step is just to stay informed, not overwhelmed or overreacting. And of course, talking to a professional always has its own benefits within itself. And so with headlines streaming at 24/7, it's easy to get swept up into the hype of fear. And that leads to emotional decisions, which are the enemy of smart investing. Your goal is to be informed, not emotionally hijacked. Focus on the data, not the drama. Look for credible sources. And when I say credible, I do not mean look for someone who says exactly what you already believe. That does not make someone credible. Or to look at the company and be like, oh, well, that they never would tell the truth. I don't know, never tell the truth. That's a little bit strong. I have found personally that there's literally a gazillion things happening every day, right? Write that in your scientific study, right? A gazillion things happening every day. And so these networks get to choose the things that they focus on. And that does speak on their bias, but doesn't inherently speak on whether what they're saying is true. And that is where the deeper discussion is. It's possible that they're completely fabricating, making things up, but it's equally possible that they're just focusing on this itty bitty little space, and they only talk about the things in that space while they ignore the bigger picture and those other items. And so for me, some of the things I like to do is I like to understand past trade wars and what they caused and how it impacted us. So as crazy as things might feel right now, this isn't our first time on the tariff merry-go-round. Using tariffs as an economic weapon, it's not new. And looking at the past can give us some valuable clues about what might be coming. One of the most infamous examples is the Smoot-Hawley Tariff Act of 1930. And so the Smoot-Hawley Act, that is one where we saw what ended up happening, where they were trying to protect the U.S. from the Depression, and it led to a global depression. Because, and you've already seen it, generally what happens is if I put a tariff or a tax on you, then you're going to most likely put a tariff or a tax on me. And then as we keep doing this to each other, it starts to escalate, where you're not allowed to sell your stuff in my country, or I'm not allowed to put the stuff and I take it off of the shelf, and it just kind of goes back and forth, back and forth. But who does it ultimately hurt? It hurts the people of that country. They can't get the same items that they used to get. And when they can get it, it's at a much higher price. And because of that reality, that is why the Smoot-Hardley Tariff Act ended up being credited by almost all economists. I struggle to say all because there's always one, right? There's always one. But most economists recognize that the tariffs actually made it much worse because we're always a little bit more connected than we thought. That if something is made in America or assembled in America or sold in America, I don't know, right? That there are so many levels to that, that there are cars that literally, because of old trade deals, that get parts done in Canada and then get sent back to the United States and they work on it here and then it gets sent to Mexico and they work on it there and then they send it back to the United States while some of the parts are being flown in from China and other countries, to where that car literally has half of its parts from outside of the United States. And then you also see that with food. That's why some food prices are going up, because we get our beef from certain countries, we get our coffee from certain countries, and there are certain items that just aren't made in America. And so it's like you just have to pay the tariff to get the item, that there is not an American made alternative. And so when you look at the wisdom of the past, in the sense that it's already happened, so what happened when it happened then? And then you try to understand, well, what's different now to make it different now? And depending on what those answers are, we can then start to recognize, okay, well, this is what always happens, right? That's the idea of wisdom. Wisdom is recognizing, hey, there's a whole bunch of patterns in the world. And if I can figure out what's going to happen next, I can make a better decision for me and my family. And ultimately, that is the goal that we're trying to accomplish. Is like, hey, there's going to be uncertain times, but what if I can make wise decisions in those times of uncertainty, so that way I get the result that I want? The goal I wanted to achieve is the goal that I ultimately do achieve. But that is why for some of you, it makes sense to talk to a professional, because you're going to feel anxious and unsure. Is this the perfect time? Do I know what to do? What's the next step? Am I doing everything right? Where the feeling of peace of mind that we're all striving for is the literal furthest thing from us in this moment. And if that is the case, it's always a perfect time to talk to a certified financial planner. And a good planner, they can be a vital sounding board, helping you to separate strategy from emotion. They can run that tariff stress test with you, make sure that your assets are allocated properly for your age, and build a long-term plan that can handle the bumps in the road. And if navigating this can feel a little overwhelming, to make it easier for you, I put together a retirement readiness roadmap for you. And all you have to do is go to happyretire.com and you can download it for free. It has 10 parts. It goes through everything, all these decisions that you have to make, so that you can have that peace of mind leading into retirement. Again, all you have to do is go to happyretire.com, and I'll put a link in the show notes available for you. So in conclusion, the ripple effects of tariffs can touch every part of your financial life. They pose a real threat to your retirement, hitting your portfolio's value while also draining your purchasing power through inflation. From the stocks in your 401k to the price of eggs, the impact is real. Retirees, especially those on fixed incomes, are caught right in the middle. But while that threat is real, panic is a choice, and it's the wrong one. The message from a century of market history is crystal clear. A calm, disciplined, and strategic plan is the best defense. It's about staying the course. It's about building a truly diversified portfolio that can handle the storm. It's about proactively checking your investments for weak spots and planning for the reality of inflation. You have the power to take control. By following the steps that we laid out, resisting panic, diversifying wisely, stress testing your portfolio, planning for inflation, and getting good advice, you can build a financial fortress around your retirement that you've worked so hard for. As always, I'm Dre Griggs, founder of Obsidian Wisdom. If you found value in this video, I simply ask for you to like and subscribe, so you continue receiving valuable insights on how to create your own wealthy retirement system. Until next time, stay safe and enjoy life.